The soft landing is over. It only gets harder from here. How much harder does it get? The reason the Fed stopped is because not just that they see what's happening with inflation, because the rate is high. The effect on the economy is sufficiently restrictive, okay? They are restricting growth in our economy.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. 2 a.m. Tuesday morning. Game on. CPI comes out in just a few hours here, the Consumer Price Index. Fed meeting. Tomorrow, the next day, it's Wednesday, the PPI, the Producer Price Index, comes out. Holy smokes, the jobs report literally just came out a day and a half ago, 2 business days ago, depending on what time you're watching this. There's a lot of data all packed in here. Remember, the Fed has a 3-part mandate. They need price stability, inflation, and full employment, jobs report, and moderate long-term interest rates. Their Fed, their monetary policy, and whether they're going to raise rates, and all these options we've been having for treasuries and bonds, and all those, So, anyway, it's a big week, and I'm going to get into some of that. I want to talk about, I've been talking about the soft landing being over. It only gets harder from here. It was as soft as it's going to get. It only gets worse from here. It doesn't get better. I'll explain that. But there's a new concept I want to talk about. I've introduced it a little bit, but I'm going to talk a little bit more about it in parts next year. Talk about the last mile, right? So the last mile is like this concept of let's think about when you go to the airport, right? You get on the plane, you're flying, and you go all the way in, and then you got to land, right? That last mile, all right, let's bring this bad boy down. Let's land. Let's get to the gate. Let's make sure, did we get you on time? Did we get you there safely? Was it a bumpy landing, soft landing, hard landing? How about your internet at home, your Wi-Fi? Your neighborhood may be wired for fiber optic cable, but your house isn't, more likely. So they got to go from the conduit out there. They got to convert it to your old school cable wire, and then coax, and then it goes into the router, which then goes into your house, which all is not as fast as, the conduit to get there, the fiber optic, that last mile, that last part. How about was tough to achieve at the same speed from all the journey before? Same thing with, how about ordering something from Amazon? By the time you see it and can order it on Amazon, they've already stocked up, they're ready, they've got you, it's done. How they get it to your house? What's the last mile? Talking about drone delivery, right? To make things faster. This last mile concept we'll be talking about, especially if the Fed this week, tomorrow, is done. If they're done raising rates, what happens from here? What's the last mile? What's going to go on next? Are we going to have a recession? Will they cut the rates? When, we've been going at this rate hiking cycle for 2 years almost. And so we're coming down the home stretch here for this part of the business cycle. Is a new bull market business cycle picking up? Are some of these signs we're looking at? I'm like, is the recession cycle threat over? And now it's time to go off to the races? Do we already have a recession? So this last mile concept is something that could be applied in many different places, and we'll some of our discussions. Had our budget meetings yesterday, technically, Monday, Tuesday, Wednesday this week. We're forecasting for 2024. We are projecting growth. We're projecting 34% growth across our 3 channels. And we have data to back that up. First of all, we're all in, right? So as a company, we're investing. We put in a new product and pricing engine as a company. We have a new portal coming out for our TPO channels. We have tons of stuff we've been investing for our retail channel all along the way. Whether it's our points of sale, whether it's our CRM, whether it's our campaigns, social coach is something we've introduced here to help people with their social media management. There's so many different things we're putting out there. So having said all that, the NBA is forecasting growth. Just a couple weeks ago, they were forecasting, I think, 19% growth, 1.95 trillion. Then I just saw a new one come out from them. They're doing 23% growth next year. Over 2 trillion in the industry next year is what the Mortgage Banker Association is forecasting. So yeah, anyone doing less than 20% growth, you need to reevaluate. I've been forecasting for, just in this industry for 23 and a half years. When you have a bad month, you didn't hit your numbers, you tend to the next month kind of forecast a little lower, play a little safe. And then you overextend that, right? And then you go, oh, okay, well, I guess I hit my numbers. I went too low. Then you kind of go heavy and then you come back low. I noticed this kind of back and forth in a normal seasonal purchase market. From a yearly perspective, kind of the same. So, this was a tough year for our industry. I just saw, all these market share reports for Q3, seeing different channels that were up and down and government business. And Ginnie Mae was the number one of the GSEs, had the most, I think they had like 30 billion in issuance for the month of, I think it was October, the number came out. And Fannie and Freddie were about 28 billion each. So, when you're forecasting, if there's a lot of negativity out there, of course, because it's been kind of a tough year, but, it isn't always like that. So are we in the last mile? We think so. We're positive on next year. Rates have already started to come down. Now, they don't come down in a straight line. Jobs report kind of brought rates back up. Okay, so maybe we're back in the 425, 420, 430 range for the 10-year Treasury. But the trend is down. And if the Fed is done raising rates and then eventually cuts, let's say between March and July of next year, rates will keep coming down. Our business is kind of cyclical. Rates go up, business goes down. Rates go down, business goes up. That's why Wall Street hates our stocks, right? They only give us credit when we're growing, right? They know better, those analysts. So anyway, so getting back to the Fed, we are going to see them with their SEP, the Summary of Economic Projections, put up or shut up time. Every other meeting, they have to put the dot plot out there, the SEP, and they have to say where they think the terminal rate is going to be. Well, back in September, the last time they did a dot plot, they said 5.6%, which is higher than the 525 to 550 we're at now. So are they liars? No, they don't like saying something and then not doing it. But of course, they said they're data dependent. So they could rely on the data and say, well, the data came out and things are softening. I think, this is where we can't forget the whole Treasury game and the global currency market and how we're vying for investment in our country to float our very expensive budget. And so, Europe didn't raise. Bank of England didn't raise at the last one. They're probably going to hold steady. The Eurozone, which has some pretty tough economies within it that are hurting, are probably likely to cut rates in the first half of 24. Bank of Japan, they're in their yield curve control. Their bank announces and releases their monetary policy next week. So remember, all these banks are kind of working in motion. So remember, back in September when they said higher for longer at the Fed, they had that 25 basis point. Hey, we still got this thing in our back pocket. We will absolutely put our economy into recession. If you don't think we will, you're crazy. Look at my dot plot. This dot plot that's coming out tomorrow, they're going to have to say the terminal rate. Are they stopping where we're at right now at 525 to 550? Or are they going to say, we might go a little higher a little later and keep us guessing? My guess is they're going to clear the deck end of the year at the last meeting. The real rates are restrictive right now. We know that. We see inflation coming down. And so they're going to say in that SEP, the dot plot, where they think the economy is going to go next year, GDP, where they think inflation is going to go next year, all the, the PCE, the CPI, the PPI numbers, they're going to talk about all that stuff for next year and put it in writing. And so we're going to have a lot to digest this week. And so jobs report, it was strong at 199,000, but it was the fourth weakest jobs report since 2021. Elliot Eisenberg, the bow tie economist, had mentioned that, there's been 4 weak jobs reports this year. They're all under 200,000, by the way. And so that's a softening labor market. And by the way, our good colleague, Paul Henman, he's always on point, and he posts the Elliot Eisenberg bow tie economist report whenever I make a reference. So thank you for doing that. Appreciate having her back. So look, data was soft in the JOLTS report. 500,000 jobs away, job openings went away, down to 8.7 million in 1 month. And we're talking about a strong 199,000 only job creation when there are so many jobs that were created for people coming back to work after strikes. I think the labor market is softening. I think it's getting weak. That means the landing is getting harder from here. That's my story, and I'm sticking to it. And by the way, China, they're hurting. I mean, their prices is down 0.5% in a month. We are importing deflation from China and their goods. Commodities have rolled over. Manufacturing is down. We're going to see that commodity price of manufacturing down in the PPI report that comes out tomorrow. So let's watch everything, see how they're doing. Have a great week. Cheers. Hey, it's KP coming to you live from Corona, California. It's almost 4 o'clock here on a Thursday. I am at 50 hours of work this week, and we still got all day today and tomorrow. So let's go, baby. Rates are coming down. The Fed has spoken, and what are people not talking about? That's what I want to talk about today. So obviously the market has shifted. We've been talking a lot on the show and in the comments down below that it's coming. Rates are going to get better. Now, they've gotten better. We saw the 10-year, I think the 10-year traded down as low as 390 today. So that's over 100 basis points. Gosh, let me go take a look at our good friend, the MBS Highway, the chart. I wish I could share the screen. I don't have that kind of stuff. But the 10-year Treasury, holy smokes, today it closed at 390, got as low as 388, and it closed at 392. And just to give you guys a little perspective, we are 499 as of October 20th. So here we are, less than 60 days later, in between 45 and 60 days, 100 basis points move on the 10-year Treasury. Now, that's what is really correlated to mortgage interest rates. Now, what's interesting for those originators and realtors out there who speak to consumers, you know how there's the misnomer like, just because the Fed raised the rates doesn't mean that mortgage interest rates were up. Well, yesterday, the Fed did nothing. They did nothing, and mortgage rates went down. So it's true. They aren't completely directly correlated. And it's funny, when they cut, rates will actually go down. But we're seeing all this movement in the market without a Fed rate cut. And why is that? Here's a little behind-the-scenes stuff that's going on. The Bondanistas, there's like 8 massive banks that basically take on all the Treasury issuance from Treasury, to buy the new Treasuries that are issued. Something like $2 to $3 trillion in Treasuries either are newly issued or old ones running off and have to like be refloated or refinanced, if you will. And so they just were fed up with it. They're like, you guys are putting too much on us. You're putting too much here. You're going to create our balance sheets, and we demand a higher yield. And higher yield means the U.S. is going to pay more interest on their debt, which is not good for our country. And so to Treasury Secretary Janet Yellen, which remember, she's part of Democratic administration. She is dovish, liberal, if you will. And there's a different worldview on the money. I'm not getting into that. I'm not getting into politics. Don't at me. I'm just speaking facts here, okay? There's a lot of spending going on. And the people in charge of buying this Treasury have said, that's enough. Like, you've done too much. $1 trillion in new Treasury issuance in Q3, was too much. And you know what? To her credit, she listened to the market, and there's only $780 billion, I believe, or $770 billion in new Treasury issuance here in this quarter. So the Bondanistas have been relaxing since that announcement. And now the Fed, they know what's going on too. Hey, we got to sell bonds. We have to sell bonds to keep our government afloat. And now we're fighting in another proxy battle, war, whatever's going on in Israel and Ukraine. We're fighting an economic war against China, who's in full-blown deflation, by the way. I'll get into that in a second. And so how do you pay for all this stuff? Well, Jerome Powell, remember, was going to get replaced when Biden took office by Lyle Brainerd. Think about that. Now, he's not as dovish. I wouldn't call him a flat-out dove like Lyle Brainerd. I wouldn't call him a hawk either. I'd say he's probably pretty fair and balanced. Remember, he's kind of downright giddy that, I told you so. They're in charge of monetary policy, not fiscal policy. And I think he's kind of excited that he's now not on the hot seat for raising anymore. And now it's all about protecting our economy and, watching the other Treasury versions around the world being sold. Japanese yen, Chinese yuan, the British pound, the euro dollar, the Aussie dollar. These central banks, they're all speaking as well. And they're all fighting inflation, and they're all fighting slowing economic cycles in their own countries and regions. And so it's harder for them to do quantitative tightening to fight inflation when we keep, having to make sure that we establish dominance to sell our bonds before they can sell their bonds. And why wouldn't we sell our bonds? This isn't like a pro-America thing, which of course I am, but we have the number one economy in the world. I didn't make it that way. No one that I'm talking about made it that way. That's just the facts. And we are the least dirty clothes in the hamper. And so people want to buy a 5% return on the most credible Treasury or fixed income security asset in the world, the U.S. Treasury. Now, the Treasury market has spoken. They helped influence things. And the Fed has spoken, and they said they're done raising rates. The dot plot, the SEP, the Summary of Economic Projections, they came out, the 19 board members, and they said, remember, 2 meetings ago, actually in September, they said we're going to go up to about as high as 5.625. Well, now they're at 5.375. So they're basically right now in the middle of the range of where the Fed funds rate is currently at. This is the terminal rate. This is the nominal rate. We're between 525 and 550 without this rate hike. The last rate hike was July, okay? So between 4 and 8 months, depending on what chart you look at, who you look at, is how long it takes before the Fed cuts. So I'm going to talk about another big misnomer. Everyone keeps talking and saying this stuff, and they're making an assumption, and they are incorrect. When the Fed cuts, okay, all right, let's say it's 8 months from July, right? So it's about March, right? I've been saying very consistently for over a year, we're going to see a cut between March and July of 2024. And I still firmly believe that. In fact, if I were to have a gun to my head, I would say a 50 basis point rate hike at the May meeting is what's going to happen. That's just my guess. I've thought that for a while. Just because the dot plot today, remember, there's a new dot plot every other meeting. There'll be another meeting in March where they're going to have to say where they think things are going to go. So at the meeting at the end of January 31st, we're not going to have a dot plot, but we'll have more data. We'll have more slowing economic data, more job losses, less job growth. Again, the soft landing is over. It only gets harder from here. How much harder does it get? The reason the Fed stopped is because not just that they see what's happening on inflation, because the rate is high. The effect on the economy is sufficiently restrictive, okay? They are restricting growth in our economy. So we had too much air with all the free money in that balloon example I use all the time. Now we're coming down. How much farther are we coming down, and how fast are we coming down? They don't know. That's why cuts are the next thing to look at. So we're not going higher. Remember they said higher for longer? Well, they lied. High. We're remaining high. We didn't go higher. Hadn't gone higher since July. For longer. How much longer? 8 months? Sometime next year? The reason they stopped raising and are now looking at doing cuts next, and we will be talking about how long is longer, is because the economy is shrinking. And if we're importing deflation from the biggest manufacturer in the world, China, what do you think that's going to do to our economy? We will have deflation. Deflation is not a good thing. Deflation is what happened during the pandemic, and I'm not saying we're going to have it to that level where the entire economic engine globally shuts down in a heartbeat because of a pandemic, a health crisis. But when the economy slowed down and China has negative half a point CPI, okay, their consumer prices, they have deflation. The only country in the world right now with deflation in the last reading. That means that it starts to spread. We are a global, interconnected, fourth industrial revolution, how you want, what you want, when you want, at the tips of your finger, industrial revolution from our cell phone. You can order $8 cheap-ass shit from China on your phone right now. And you might do that if you lost a job here in America. If you're in the housing industry, you lost a job. It sucks right now. Yeah, rates are getting better. January and February aren't great months for our industry. And I saw someone on CNBC saying, hey, the soft landing, good job. They did it without a single job being lost. Well, yeah, net, if you look at all the jobs reports, we haven't had job losses yet, but we have them here. And if you look at the MBA's forecasting projections, they're projecting a 5%, up to a 5% unemployment rate by the end of 2024. 2 negative GDP quarters in a row, Q1 and Q2, and 0.8% growth this quarter. Sufficiently restrictive means the rates are high, and that means they're going to continue to hurt the cost to borrow. Cars, personal credit cards, everything is more expensive. So people back off. especially if you don't have a job. You're not going to pay for anything. So deflation is now the worry. So bad news on economic reports is good news for us until it isn't, until we actually have a recession. And the nominal rate, okay, 550, 525 versus where inflation is, you subtract that, you get the real interest rates. We're pushing almost 3%. If inflation keeps coming down, the real interest rate gets really restrictive. But you know what? Santa Claus rally is on. Let's enjoy the holidays. Have a great weekend. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.